A breakout finder combined with a trend filter and volume indicator can make a very strong strategy. Let's take a look. Hi traders, today we'll review this powerful trading strategy that's been flying under the radar for a while now.
Yesterday, you said tomorrow, so just do it!
We'll dive into all the indicators in detail, and as always, you'll find links to them in the video description. We'll also cover the strategy rules and potential pitfalls, so by the end of this video, you'll have a complete picture on how to use it and potentially make profit with it. So, let's get straight to it.
Do it! Just do it!
First up, let's break down the 3 key indicators we're using. Let's add our first indicator to our chart. It's called Breakout Finder Indicator by Lonesome the Blue. A breakout finder indicator is designed to identify potential price breakouts. It identifies key pivot points in the market, draws support and resistance levels automatically, and alerts you when price is testing these levels. This indicator adapts to market conditions, showing potential breakout zones in ranging markets and helping identify continuation patterns in trending markets. It can be used on its own, but I'd strongly suggest not to, and instead combine it with some confluences. Otherwise, you'll definitely get some false signals. Let's change its period to 5 and the breakout length to 100. It's always a good idea to add a trend filter. For this particular strategy, I prefer to use the exponential moving average, or EMA for short. For those of you who don't know, the EMA is a versatile indicator that provides valuable information about the overall trend. It gives you a clear visual of the trend direction, acts as dynamic support or resistance, and smooths out price noise while remaining responsive to recent price action. It serves as a dividing line between bullish and bearish bias in the market. Let's adjust the period to 100, but hey, you're free to experiment if you think other periods would work better for you. I'll also change the color to yellow and make the line thicker so you can see it clearly. By now you probably start getting a picture of the strategy overall, but that's not all. It might sound obvious that we enter when the price is above or below the EMA, depending on which direction we're looking to enter, but there's more to it. Let me show you. Here you have the candle close above the EMA and the breakout signal given by the breakout finder indicator. We would lose money if we entered here as the price reversed immediately. What's missing and why did we fail? The answer is volume. There was no volume accompanying this breakout. Our third indicator complements this strategy very well. It's called Volume Breakout Indicator by TradeStation. This indicator focuses on volume analysis, which is crucial for confirming price movements, in our case, the breakouts specifically. It highlights volume spikes that coincide with price movements, uses color coding to show whether buying or selling pressure is dominant, and compares current volume to recent averages. This helps in understanding the conviction behind price moves and the strength of potential breakouts. We'll adjust its period to 50 and change the color to white for better visibility. Now, let's talk about how these 3 indicators work together in our strategy with some examples, and then I'll give you some extra tips on how to make this strategy even better. For long positions, price needs to be above the EMA. We want to see a breakout signal from the breakout finder, which is this blue triangle. The volume breakout indicator should confirm with volume breaking above its moving average.
Few moments later.
For short positions, price should be below the EMA. Look for a red triangle from the breakout finder. Again, we need confirmation from the volume breakout indicator. Going back to the settings, as I always emphasize in all my videos, these settings are a starting point. As you become more familiar with the strategy, you may want to adjust them to suit your trading style and the specific assets you're trading.
Nice.
Now let's talk about managing risk. Use stop losses. Place them below recent swing lows for longs, above recent swing highs for shorts. Mind your position sizing. Stick to risking 1 to 2% of your capital per trade. Set take profit levels. Aim for a risk-reward ratio of at least 1.2. Consider trailing stops. These can help lock in profits as the trade moves in your favor. Stay market aware. This strategy tends to perform better in trending markets. Be cautious in ranging or highly volatile conditions. Like any strategy, this one has potential pitfalls to watch out for. False breakouts. These can occur, especially in choppy markets. Don't chase every signal blindly. Quality of trades is more important than quantity. ignoring the broader market context. Always be aware of major support, resistance levels, and overall market sentiment. Emotional trading. Stick to your rules and avoid letting emotions influence your decisions. There you have it, a breakout strategy that combines price action, volume, and trend following. It's a solid approach that can be effective when used correctly. Remember, successful trading isn't just about having a good strategy. It's about consistent execution, proper risk management, and continuous learning. Before trading this strategy live, make sure to backtest it thoroughly and consider paper trading to understand how it performs in real-time market conditions. If you found this breakdown helpful, please like and subscribe for more trading insights. Feel free to leave your questions or suggestions for future videos in the comments below. Until next time, trade smart and stay disciplined.